we will need to raise rates. We then make clear that we would do so. We use the term coming months, which ties back to what we've just been saying really about the data and the labour market. It is not a particular meeting. It is, I think it's Hughes used the phrase, all meetings are in play, and it's important to emphasise that. Now, those two statements they're consistent. Now, I accept that the markets, of course, have to take our conditional statements and translate them into unconditional views of the world. That's what they do. I would say, though, that all the evidence we have is that for the vast majority of market participants, as far as we can tell, they took the same view leading up to the meeting that we did, that it was a very close call. I mean, there was a poll of 45 market economists, and they were 23, 22, I remember. So, that's pretty fair, actually, as a judgment. Now, there were some people, or some institutions that took very big positions and had been taking very big positions over the course of the autumn, and some of them have lost out. Some others have gained, I think, but clearly there's, some feel better than others.
And was that expectations management, and was that, because it did affect expectations of some players in the market, was that unfortunate? Was it accidental? Are there any lessons that you'd learned from this about doing it? Because I remember your predecessor commenting about future interest rate rises and saying that the next move will be up this. I can't remember when this was. It was some like 2012.
Well, we've gone through, I think, various sorts of various iterations of guidance over the years. I think at the moment, I would say, we're not of the view that, and particularly with the high degree of uncertainty at the moment, there's a very high level of uncertainty at the moment in the economy, that making statements of the sort you just said would be, hazardous, frankly, to say the least. I'm not personally convinced it's a good thing to do anyway. Yeah. So that, the point, the guidance, if you can call it guidance, the point I was making in October was about the framework. It's about, don't forget what our framework is. It's about inflation. We are in the price stability business.
One other issue, the monetary transmission mechanism. There's quite a lot of speculation. This may not be you might find it's not as strong now as it was some time ago, because there are more people on through the mortgage market. There's obviously different mechanisms, but there's fewer people have mortgages now, proportion of households. They're more longer term, they're more fixed rate, etc. Are you worried that when you pull the monetary policy lever, you might not find it has as much effect as you might hope? I don't know if it's a question for you or for Hugh.
Well, we have to keep sort of, in a sense, studying the transmission mechanism because it changes, as you say. Mortgage market being a sort of primary part of it, in a sense, and there are more people on rather longer fixed rate mortgages. So we have to factor that in. I would say over my time, which I've been around in this sort of monetary policy for 20 odd years, off and on. I think certainly probably our view of the duration with which the transmission mechanism works out has probably lengthened somewhat.
I agree with that. I think it's important to put that comment in context. We've spent a lot of the last decade plus experimenting really with a whole new set of monetary policy instruments, and maybe we'll turn to some discussion of those later. Catherine's already commented. And I think inevitably what were initially introduced as unconventional instruments in the aftermath of the financial crisis, I think there was much more uncertainty about how those may operate. So, in some sense, and this is reflected in my own decisions over recent months since I joined the bank, I think going back to a interest rate-based signalling and operation of monetary policy as sort of the core is really turning back to an area where we do have more knowledge, hopefully, and perhaps gives us a little bit more confidence in how we can assess transmission. Although, to your point, as the structures in financial markets change and so forth, nothing is ever for certain. We live in an uncertain world.
Michael, coming to you. So you voted for an interest rate rise to 0.25%. Obviously you were outvoted. That's democracy. It happens. I'm just wondering whether you're worried about the consequences of not rising interest rates now in your latest meeting. Do you think that will lead to inflation running out of control then, or at least missing the target? We're not going back to the 1970s. You don't have to repeat that bit. But what are the damaging consequences of not having raised interest rates, which you wanted to do?
Well, in general, the risk of delaying too long is that then, if and when interest rates do have to rise, they have to go up a little faster and potentially a little further. So I would put the risk in those terms, but also that inflation expectations particularly among households and businesses, might drift up a little further. But if I can come back to your point about communications, look, monetary policy is most effective if the expectations of households, businesses and financial markets for interest rates over the next few quarters, the next year or two, are broadly aligned with returning inflation to target. And if households, businesses and financial markets broadly understand our reaction function, in the sense that if the economy is weak and needs support, we would loosen policy. If the economy is stronger, if inflation is a problem, we'd be more likely to tighten policy. But it's not possible, nice though it might sound, to be able to promise where interest rates are going to be 6 or 9 months out, because that depends on what the economy does. And there are inevitable uncertainties about that. And from meeting by meeting decisions, I mean, I don't know when I come into each meeting how everyone else is going to vote. So there are always uncertainties over the decisions from month to month. I mean, in theory, we could get rid of that by deciding at one meeting we're going to change interest rates at the next meeting, and then when we announce it, no one would be surprised by it because we would have told you previously. But I mean, that would be a futile thing to do, wouldn't it, really? So it's really not possible to remove all uncertainty about decisions from monetary policy, either over the medium term, because it depends on the economy, or from month to month. What we do try to do is to discuss our views on the economic outlook, to try to ensure those broader points, that interest rate expectations are more or less aligned with returning inflation to target, and our reaction function is well understood, to ensure that those points get through.
You also voted to cease the asset purchase, the quantitative easing programme. Why do you do that?
Well, I've been voting for that for several months. So I voted that way at the August meeting and the September meeting. And we've talked about the inflation pickup, but there's a part of that which is energy prices, which is likely to have a transitory effect on inflation. It'll raise inflation for a period, but it'll then fade away. There's also a pickup in global goods prices, which I think is likely to have somewhat more persistent effects on inflation here. And we've seen this gradual shift to a tight labour market, signs of pickup in pay growth, and rising service sector in inflation. And that's the part of the inflation outlook which I'm most concerned about. And that's why I've been voting for a withdrawal of some of the policy stimulus over the last few months, starting with the end of the asset purchase programme a few months ago, and then as that nears its natural end, moving on to higher interest rates.
And last question, coming back to the Governor. You voted with Hugh to continue the asset purchase programme. Why do you do that? Is it because you felt, having announced the total of 150 billion, you felt you had to complete it, or were there other?
Yeah, so 2 points Michael sort of actually led into the first one, which is we're very near the end of it. It's only got about 4 or 5 weeks to go now. And on its own, that wouldn't, I mean, in fact, there's not much left. And that's important because when you hear about tapering in the context of the Federal Reserve, they're doing open-ended QE in the sense there is no limit to it. So tapering, of course, is a critical decision. I mean, we're almost tapered out in their language. But the reason that's important, in my view, is that we've adopted this different approach of doing fixed amounts of QE. I mean, Catherine's right in her characterisation of the decision, exactly a year ago where we were. Remember, we'd got COVID returning, we'd got the economy facing that. We hadn't got vaccines at that point either, so it looked very different. And Catherine's right to raise the question of sort of, the world's changed. How long does it go on for? My concern, given the small amount left, was that if we stopped it, we would be raising a quite substantial question mark in the future, should we need it, as to when we announce fixed amounts of QE over certain periods, would the market say, well, yeah, but you don't redo it, do you? And I felt that for what it was worth, it wasn't worth, compromising that point, given the small amount left.
It was about future credibility.
Yeah.
Okay, that's all my questions. Thank you.
Thanks, Anthony. Julie, please.
Thank you very much, Chair. I'll go back to you, Governor, and just maybe try and press you. You referenced the term you'd used in the press conference about interest rates coming months. Can you give me more of a detail? I mean, is it 2 months? Is it 10 months? What's your expectation of when you might be looking to raise?
Hughes made the point, I think, in an interview, every meeting is in play in that sense. And I don't want to sort of, because that really would fall into the trap that I was seeking to avoid in October of saying, yeah, but this is a really important meeting. That's not the case at all. It so happens, we meet every 6 weeks, the labour market data come out every month, that we will have 2 sets of labour market data between last one and the next one. And that will straddle over into October properly, so that we will have the first set of post-furlough labour market data. Now, what they will reveal, we remain to be seen. And of course, there's lots of other data we'll have in the meantime as well. We're going to have an inflation number this week as well, for instance. We'll have a lot more activity data. So it really is. Sorry, I don't want to sound evasive because I'm not meaning to. It really is important when we say coming months that every meeting is created the same in that sense.
Yes,
It's just that some come sooner than others.
Let me try a what if. If, for instance, recovery was in line with your central forecast, what would your expectation be in that scenario, in terms of the timing?
I think then we would have to make a judgment as to how solid we felt the data were, how much we could be confident with that going forwards. What I think you should take very clearly from the statement we made in November that if we pass that test, then our view is that interest rates should rise.
Okay, thank you. And in terms of the levels, how high are they likely to go?
Well, again, we're not going to take a view on that. I mean, what I will say is this, because it was an important point in what we said in what we said in the report and what was said in the press conference. So we condition the forecast on the market curve at the time. Well, it's a 15-day moving average leading up to the point at which we do it. Now, what that curve suggested was that at the sort of outer point of the forecast in 3 years' time, we'd actually got inflation just a bit under target. But probably more important than that, we'd got a negative output gap opening up, so that the trend line would then be inflation falling further below target. Sorry. And we did make I think a fairly clear message. I don't think it was very subtle really, that did not look really in line with where we would want to have it. So in a sense, the market curve wasn't where we at that point has changed since then. The second point I would make in that context is that the MPC going back in time used to actually condition the forecast on constant interest rates, not the market curve. We still produce the constant rate forecast, but it's not the main one anymore. But actually it has more sort of, it probably is more interesting this time, because what the constant rate forecast tells you is that inflation doesn't return to target. It sticks around 2.6, I think, or something like that. And that's obviously significant in terms of what we need to see policy do if things evolve as predicted. But I think the market curve had rates going up from 10 basis points where they are now to, first of all, to 25 and then another 3 25s next year. And we are not endorsing any curve, by the way, so that's a matter of fact rather than any endorsement from us.
Okay, thank you very much. Charlie Bean referenced, he kind of invoked a material risk of 1994. I don't know if you saw that, steep rise in bond yields, interest rates rising.
Market shock.
Yeah, I mean, how much of a risk would you say that is?
With all due respect to Charlie, who I hold in enormous respect, I'm really not with him on this one.
Okay.
I think the reason is that we are now, as Hugh was saying earlier, in a very different period, because I think a critical point to make is that obviously we've been in a world of very low interest rates since the financial crisis. That is driven by underlying structural reasons in the world economy, particularly to do with aging populations. We don't see that basic sort of context of low interest rates changing for the foreseeable future. So when we start talking, the reason this is important is that when we talk about interest rates going up, sorry, I talk about interest rates going up, but we're talking about it within that context. We're not talking about some move back to a very different environment in the past.
Thank you. I don't know if anyone else wants to expand on any of that.
So I can talk a little bit about that. Charlie Bean and I are both MIT PhDs, same cohort. So, we kind of come from the same background, I suppose we can say that. So a couple things. First, I think it's important to note that one of the factors in today's environment is that we did see a very big change in government bond yields around the world in recent weeks. But we did not see a similar change in private financial market indicators. And so there's a disconnect between the interpretation of the state of the world from the standpoint of government versus the standpoint of the private sector and private sector finance. And I think that disconnect is one that's important to keep in mind when thinking about the prospects going forward. But the other sort of thing to consider in the context of how high can bond yields go, government bond yields go, there is an emphasis on the demographics associated with long-term stable interest rates, but we also have to think about other elements that are relevant for that anchor. One of them is productivity growth. There is capital stock, which is where business investment becomes an interesting aspect of the question. Labor force, and that's where the demographics component is. But we also have to think about risk premia and whether or not there's something fundamentally changed on that one, variable. But the one I look at, or the two that I look at that are most important when thinking about these long-term interest rates is productivity and capital stock. And on both of those, I think there are, we could be looking at a different environment going forward with very strong productivity growth and robust investment, but that's not really what's in the projections. And so that suggests that the environment that Charlie is talking about is not the one that we're likely to return to anytime soon.
Thank you very much, Catherine. I mean, actually, we've heard various different perspectives and votes. I mean, do you ever get the impression that there is groupthink or a danger of groupthink in any of these decisions? Hugh, perhaps?
Well, as a newcomer to this game, I think I have with Catherine, I have a little bit of a different perspective maybe from others who've been in the game for longer. And I think there's a healthy commonality in terms of what we're trying to do. There's a lot of clarity in, as Andrew put it a moment ago, we're in the price stability business. So we're not arguing about what our ambition is. Our ambition is to deliver on the inflation target. So that's a kind of commonality across the group. And that's a remit that is delivered by others to us. But I think there's a healthy debate, which is reflected in this room. So I'm looking out the other three people at this hearing accompanying me from the MPC. They all voted different ways. And I think that reflects the fact that there is a healthy debate going on within the committee. But that debate is really deeply rooted in a way of thinking about the world, which allows that debate to be oriented in a healthy way. So, for example, I've listened this afternoon to both things, well, all three others, but Catherine and Michael have said. It's not that I would repudiate those arguments and ask myself, what are these people thinking? I mean, naturally, I have a lot of respect for my colleagues, but I have a lot of respect for the arguments they're making. So when I approach the problem, and I also come to this issue and think this is a finely balanced set of decisions from an individual point of view, and a finely balanced set of decisions from the committee as a whole, it's because I recognize, on the one hand, some of Michael's arguments that if we don't act, there is a danger that inflation achieves some self-sustaining momentum that we'll have to resist down the road. But equally, I think that if we act prematurely, there is a danger we derail some of the recovery, which is still, in some respects, quite fragile. So it's balancing those two risks. It's the two-sided risks that Andrew talked about, and steering our way between these two risks, that's key. So we have a kind of commonality of framework and a commonality of ambition, but inevitably, when you're steering between those two risks, some people will fall on the one side, some people will fall on the other side. And if you have 9 people who are all making these finely balanced judgments, it's not so surprising, maybe, that there is a little bit of uncertainty about what any individual decision is in terms of magnitude or timing or the first set of things you asked about. But I think that's a healthy reflection of the strength of the system, which brings transparently some of this debate out into the public domain rather than suppresses it. I worked at a different central bank earlier in my career as a staff member, and in that central bank there is a little bit of a tendency to sort of try and create a consensus, which in some cases may be an artificial consensus, and I think that's probably not a healthy way to run monetary policy.
Well, certainly, if I could just speak as the chair of the committee for a moment, I mean, I think I regard it as one of the most important things that I ensure is that these different perspectives are brought to bear, and that we we really do deliberate on this. The real challenge then, and we saw it this time, is then I think we do owe it to the sort of the public out there to give as clear a message as we can. So the crafting of those paragraphs in the statement, which try to sort of, in a sense, meet these two objectives. There are different views on the committee, but we try to give as clear a message as we can as to how we're thinking and what we think can happen. It's a time-consuming business, I would say. But that's right. I mean, that's important because it's critically important that we try to balance these two things at that point without falling into the groupthink trap.
Thank you very much. Did you have anything to add to that, Michael? Or?
No, I agree with that. I mean, I think honestly that if you see the range of views among the committee members, I don't think groupthink as a accusation really has much bearing.
Thank you. I'm out of time anyway. Thank you very much. Thank you.
Harriet, please.
Thanks very much, Chair. Governor, we've been asking as a committee about inflationary risks all year. And at the beginning of the year, your response was, well, inflation's well below the target. And later on it was, well, we're expecting inflation to peak at lower levels than we are now. And now, of course, we're hearing this message that it's going to be temporary, but we're now looking at levels that are, some multiples of your, or a multiple of your target. And it does really concern me that the risks to inflation seem to be so much more to the upside than was anticipated by yourselves at the beginning of the year. We've heard from all of you that you don't think a return to a 70s style wage price spiral is possible, that somehow the labour market is different and so on. But Governor, last time I asked you about the perception that the government itself now had a policy of trying to raise wages, and to raise wages particularly for those who are the lowest paid, and particularly making sure that wage growth responded to the fact that we have now left the European Union. And I just wondered if that anywhere feeds into your perceptions that wage growth is going to not be under enormous pressure in this changed economic environment that we're in.
Well, yeah, it's a very interesting question. Let me try and sort of split out a number of different elements of it. I think this probably goes back to the discussion we had last time, it's important that we have a framework that enables, where it's appropriate, an adjustment in relative wages. Because that can happen, for all sorts of reasons that can happen in the economy. So, let's take the obvious example. It may be that lorry drivers are, HGV drivers are relatively underpaid now. If that's the case, then we shouldn't obviously have a monetary policy framework that says, well, you can never do anything about that. And that's one reason why we have a 2% inflation target and not a 0% inflation target. Because if we had a 0% inflation target, it would be very hard to manage any of that. Now, obviously the challenge you get then is, it's all very well to sort of say that, but how does it work in practice? And doesn't it sort of create sort of these sort of second round effects that you might talk about in wages? And that's where we have to make, frankly, very difficult judgments. And I'm afraid, I suspect we will have to do that over the coming months as we try to sort of pick our way through the evidence as to what's going on in the labour market particularly. I mean, the other thing I would say is that I think the labour market has tightened already. We've talked about wages. Let's talk about quantities for a moment. It's quite interesting to compare back to end of 2019, so pre-COVID. And what we see is that unemployment is about just over 200,000 higher. It's obviously an important number, but it's not anywhere near as big as we feared it would be. Inactivity, that people are not searching, haven't got a job and are not searching, is more. It's about 450,000 higher. And we really don't know. I mean, that's split into sort of a young age group who are continuing in education, who we think will obviously come into the labour force after that. And an over 50s group where we have a real question mark. I mean, we just don't know what they'll do. Will they come back, won't they? the public sector employment has grown by about 280,000, which is not a trivial number in this grand scheme of things. I mean, if you look at the sort of the shortfall, for instance, in the consumer service sector employment, which is still coming back, it actually is those two numbers more or less offset each other, actually. So that has tightened the labour market. Even more hazardous, we think total population and therefore total labour force is probably smaller now than it was projected to be in the end of 2019, possibly by 300,000 or 400,000. There's quite a lot of tightening of the labour market in those numbers.
And vacancies are at a record high.
Vacancies, yes. So
really significantly higher.
So there's the million number, but it's just to do it on a comparable basis, they're about 300,000 higher than they were at the end of 2019. So yeah, the vacancy to unemployment ratio has gone up. Yeah.
And in terms of freedom of movement, that's ended, and of course, the government is deliberately trying to use that to raise wage levels. So it's been very clearly stated by the Prime Minister, by the Business Secretary, that now that freedom of movement is ended, there's a very clear policy to use that to raise wage rates.
Yeah, on the population number, I have to be honest, we cannot separate out Brexit and COVID in that sense, because they're both, over the same time period, they both had the same effect. So I honestly can't give you a steer on that. On the point about raising wages, I mean, the thing that's obviously, having said the point I made about relative wages, I mean, more broadly, of course, the question is, how does this tie into productivity gains? That's the important question, because obviously it's much more sustainable to raise pay when it's attached to higher productivity.
Although I think this committee's looked a lot at productivity, I'm not sure that, and I'm sure you have too, I'm not sure that we've seen anything that would make us feel it's going to make a big shift at the current time. But I want to move on to a different topic, which is around inflation expectations, again, which have been cited when you've given us evidence in the past about one of the things that you monitor very closely. Yes. And I want to turn to Hugh now and ask about the speech your predecessor made in his final salvo, saying that inflation expectations and monetary policy credibility feel more fragile than at any time since inflation targeting was introduced in 1992. What's your view on inflation expectations? And can you factor in this, your reaction to the paper by Dr. Jeremy Rudd about whether or not it is wise actually to think that inflation expectations are a good anchor for central banks to be monitoring?
The first thing I'd say is we have seen rises in short-term inflation expectations in recent months. And we largely associate that with the rise in actual inflation and some of the things you just mentioned to Andrew. Because the people reporting those or pricing those inflation expectations are reflecting, they have risen in response to the same disturbances, the rise in energy prices and so forth, that to some extent have surprised the bank's forecasters. Where I think we probably agree with the paper, the Federal Reserve paper you allude to, is that we would put more emphasis on medium to longer term measures of inflation expectations, which I think are more reflective of what is going on in feeding through to what's going on in pricing behaviour and...
It's priced into index-linked gilts or
well, that's one measure.
What measure would you prefer?
Well, I think we have a box, which is in the monetary policy report we published last week. And I think we try there to look across a broad range of measures. Some measures coming from households, some measures coming from firms, some measures coming from other professional forecasters, both in the private and the public sector, but also financial market measures like break-even rates and measures derived from index swaps. And I think if you take a kind of holistic view of all of that, and some work has been done in collaboration with the bank to try and do that in a pretty structured way, we still draw the conclusion that overall those medium to longer term inflation expectations remain anchored at levels that are broadly speaking consistent with our objective, and we draw some comfort from that. But what I think is important to recognise, which again is an element of what is discussed in this Federal Reserve paper that you mentioned, is that if those inflation expectations or any subset of them begin to move away from those types of levels, and just to repeat, we don't see evidence of that as yet, then that is a challenge either to our analysis or our policy. And I think what's kind of key in that respect is that we meet that challenge. So either we have to accept that those people reporting in the surveys or pricing the instruments that you mentioned, either they're right and we're wrong, in which case we should change our assessment and change our policy, and that's not where we are now, or we need to convince them that we're right and we have the right assessment and the right policy. Either way, I think the first step in that process is to convince ourselves whether we believe what we're doing or not, rather than respond in some sort of mechanical way to the movements in, for example, financial measures, financial market-based measures of inflation expectations, which can be difficult to measure and can be quite volatile on occasion. So it really goes back to the first discussion we have, or other discussions we've had this afternoon, which is, do we believe in our assessment of what the developments in inflation we've seen? Are they really transitory, or are they becoming to be more embedded through wage and price setting behaviour into longer term developments?
What I'm hearing you say is that you do think that shorter term inflationary expectations are a bit of a lagging indicator, and that they're responding to the fact that inflation has risen, but that the longer term anchor is something you still feel is reflecting sort of confidence in your inflation targeting framework.
So I think on the point I would make is shorter term inflation expectations, they're really a reflection of actual inflation to a large extent. So of course we look at them, they're lagging, but nonetheless we see actual inflation too, and that's the focus of our analysis, to understand what's driving actual inflation. When we look to, so what's more important in our assessment is looking to medium to longer term inflation expectations. At the moment, we draw comfort from the fact that in this kind of holistic assessment, they remain consistent, or they remain at levels consistent with us achieving our objectives. So that is a pointer to our credibility. It's a little bit weighs against the comment you made from Andy. But I think the kind of key point I'd make, or an additional point I'd make, is that I think it is important that we treat those expectations as a prompt for analysis rather than response to the mechanical.
You do accept that your inflation forecast this year has been wrong by a significant order of magnitude?
I mean, I think if you look at the inflation forecast that was published back in the March Monetary Policy Report and you compare it with it now, there's been a substantial revision. I mean, there's been an error made in terms of and there's been a substantial revision. I mean, the point I'd make is that is because of some of these factors we discussed earlier, which were, I mean, both to me as an individual, I was not in the bank back in May, but I think they were genuine surprises that the behaviour of wholesale gas prices and energy prices and so forth have been much higher than was expected.
Thank you, and I want to just
say,
ask
with respect to Andy and his
Governor.
1992 point, actually the errors were larger in 2008 and 2011. So it's not, I mean, that's not excusing it, but these things have
Worse wrong before, is that what you're saying, Governor? Yeah.
We had larger forecast errors. And inflation, I mean, the point is, inflation has gone up during the inflation targeting period. We had peaks in 2008 and 11, and the forecast errors were larger. Now, it doesn't excuse, obviously we've had particular issues to deal with this time, but the 1992 point is not quite right, actually.
Can I just turn to Michael, if I may, because when we took evidence from the Office for Budget Responsibility, and Sir Charlie Bean in particular was talking about the 1994 bond market, and you may also remember that in terms of how quickly bond prices shifted when they lost confidence in the ability of central banks to get inflation under control. How worried are you about those kind of risks? You've said that you're not worried about the 1970s type of risk, but the 1994 type of risk in terms of the bond market's reactions.
No, I wouldn't draw a close parallel to then. I mean, then we were coming out of a period in the 80s in which nominal interest rates have been much higher, typically 10% plus. And as we moved into the 90s, inflation expectations were much lower in the aftermath of the recession from 90 to 92. But there was a lot of uncertainty in markets, and I worked in financial markets then, as to whether, as the economy recovered, the normal level of interest rates would be, I think rates had been cut to 6% in early 93, as to whether that would be the normal level of rates, or as to whether it would be back to the double-digit rates that we had typically seen in the 80s. And markets were generally unsure as to what the normal level of rates were going to be, and for a period priced in a return to the relatively high interest rates of the 80s. So if you think of the current position, we're in a relatively low neutral rate world. That's been the case for the last 10 or so years. So if you think of the UK, the levels of interest rates we've seen have been much lower than in previous periods. And I think that's likely to continue. And I have to say, I think that's quite widely understood in financial markets, that sort of uncertainty as to whether we're in a low neutral rate world, which was there in '94. I don't think it's as, I don't think it's anything like
in both cases you could be making the same recency bias error in terms of your expectations about future price changes.
And it would be a thing to watch out for. And we do pay a lot of attention to various measures of inflation expectations. I would say in particular those among households and financial markets. They have crept up a bit recently. I would still regard them as well anchored. I wouldn't want to see them trending up further from here.
Nor would I, because for my constituents, with a small amount of savings, they've just seen them erode very significantly over the last 12 months. Thank you, Chair.
All right, thank you. Emma, please.
Thank you. Good afternoon, everyone. I'm going to ask a quick question on debt and then move on to look at the link between low interest rates and higher housing prices. But just a quick question on debt. I just wondered what the bank's view were on how developments in the economy and the likely path for interest rates may affect households who've built up debt during the pandemic.
Well, happy to start on that. The cost of debt servicing to households now is well below what it was sort of pre-financial crisis. So it would require a very substantial increase in interest rates to take us back to that era. I mean, we have done some work on this actually. It would probably require something in the order of 2 to 2.5% increase in interest rates to get interest payments as a share of household income back to something like the average between 1999 and 2006. So, yeah, we are in a sort of period of, relatively speaking, compared to history, low debt servicing costs. Now, of course, that, however, does need to be sort of, in a sense, looked at from the point of view of the whole distribution of household debt. So I'm talking about averages there. If I could just sort of comment on the FPC for a moment, because where the FPC comes in, we've had household tools, as we call them, the tools in place since 2014, actually. And to my mind, the most important tool there is that we have the limit on the flow of mortgages to those with loan-to-income ratios at the upper end of the distribution. We've always said it's a 15%. Sort of in a sense limit, which actually the banks don't get near to actually. We said, I mean, there are cases where it's appropriate to lend at those rates, but to my mind, it has helped to, in a sense, act as a guardrail, if you like, to not only look at the average cost of debt servicing, but the distribution as well. And it's brought the distribution sort of back inwards, certainly in that sense.
Just to sort of dig a bit more on the comment about distribution, because some of the evidence I've read is that when you look at the data as the average for the country, the amount of debt seems low, but that's because in the pandemic, some people have been able to save an awful lot and other people haven't, and that may skew the when we're talking averages, those figures could be skewed. I just wondered if, when you're looking at the impact of possible interest rate rises on household debt, whether you're looking at that across the range. I
wasn't netting off saving against debt to get those numbers. But you're right that there has been a substantial increase in household saving during the COVID period above the sort of the normal level. And we do think that is concentrated, relatively speaking, and probably in two groups. One is those with typically higher incomes who have tended to have more constant incomes. Second one is the elderly, who've had fewer opportunities to spend. And it's something we think a lot about, obviously, in the MPC context, about what will be the, in a sense, behaviour towards those what weren't expected savings, if you like.
I just wondered, when you're looking at this, do you map out the impact on the different sections of society when you're looking at what impact interest rates would have on a household? Do you look at sort of the different how society, because we're talking about difference in constituencies. My constituents aren't so worried about savings having high inflation. They're worried about servicing debt. And I just wondered when you're doing your...
Well, I mean, there's a model, actually, there's a set of models sitting behind what we do, which inform us, and we've also got the work of our agents around the country. There's a certain amount of regional data. We get quite a lot of survey-based information, and we use that. We're avid consumers of data in that sense. So we do, yes, try to balance these things. Obviously, at the end of the day, though, we're setting monetary policy for the whole economy. That's the reality of it.
Okay, thank you. I'm just going to move on to looking at the impact of interest rates on housing prices. So to what extent do you think low interest rates are the key driver of high level of house prices rather than a lack of housing supply?
Well, I'm sure my colleagues will want to come on this. Let me say a couple of things about what's happened in the last, since the COVID period. It's very interesting. I mean, two things are notable in the last 18 months. One is that we've seen a reversal of the regional pattern of house price increases that we had seen for a long time before COVID. In other words, for a long time before COVID, the fastest rate of house price rises were in London and the South East. We've actually seen the opposite during the COVID period. The weakest rate of house price increases have been in London and the South East. Faster rate of house price increases have been almost everywhere else, turns out. The second thing that's changed is that the distribution of house price rises across different sorts of properties. Again, pre-COVID, we were tending to see faster rates of increases of prices of flats. Here we're seeing faster increases of prices of larger houses outside London in parts of the country. Now, our agents have this great saying for this called the race for space, which is as opposed to the space race, which I just about remember as well. And of course, this is to do with working patterns and living patterns, and that people are taking advantage of living further away from their place of work and buying larger houses in areas that have got lower house prices, which obviously is having a regional effect. I don't know, but colleagues will no doubt want to come in on this.
I mean, I think the only thing I would add to...
Yeah.
Sorry.
Go ahead, go ahead. Go ahead, Hugh.
No, I mean, the only thing I would add, is just to take note. I think we see house prices have been rising for sure, and of course, in addition to this race for space, we've had the stamp duty holiday and other things that have happened relatively recently. But it's also important to keep in mind from a slightly longer term historical perspective that if you look at real house prices, so house price corrected for the movement in the price level in general, we're still not seeing a level of house price or a level of house price relative to incomes that is really as high as we saw in, for example, the sort of mid-1970s or in the late 1980s. So the kind of characterization of the current situation as being a kind of house price boom, I would probably characterize both the early to mid-1970s and the late 1980s as really being house price booms in some sense. I think we're not in that characterization now. So I think that's an important thing to sort of keep in mind in sort of debating this issue.
Sorry, Catherine, did you want to come in?
Well, I was just going to note that there is research in the bank that has tried to tease out the various elements that you're commenting on. And they ascribe about 50% of the price increases to this race for space. In other words, this shift in preferences. And so if that's true, then the marginal increase in price that we should see over the course of the next year or so, we would probably not see as much of an increase to the extent that people have made their adjustments. But, of course, we could find more people wanting to move out, but there is more people, considering whether or not they'll stay in the city as opposed to move out. So about 50% of the dynamic associated with race for space, and then as you said, very clear price dynamics associated with stamp duty changes. And so that means at the margin, sort of interest rate driver is not as sort of as prominent as one might think.
Thank you. Which proves a point I keep making, Chair, which is people should move to Hull because it's much more affordable and you get a much bigger and nicer standard of living and bigger house. But I'll park that for the moment. I just wondered if you'd be able to comment on what's happening in New Zealand and their government's decision to instruct their country's central bank to consider the impact of its policies on the housing market and then looking at it in a slightly different way.
Well, I think the only comment I would make is that we've, as I was saying earlier, really addressed particular housing market risks through the Financial Policy Committee, and I think we're more content to do it that way than through monetary policy. And the FPC, is a sort of different beast in that sense. It's got a very big range of potential tools it can use. We're reviewing the housing tools at the moment. I review them quite often because they are tools, I would say, that probably unusually for a central bank have the most direct effect on individual members of the population, and so I think it's appropriate that we do review them, and use them minimally.
So if I could add something here, you, Parliament, set our remit. We will follow faithfully the remit which you set us.
Sadly, I don't get to choose it. We're working on it. Apologies. Compared to a few decades ago, far few younger people can now afford to own their own home, and rents take up a larger proportion of their income. To what extent are low wage growth and high housing costs a greater threat to the living standards of young than the prospect of higher inflation and interest rates?
Well, again, I'm sure colleagues will come in. I mean, I always find it interesting in this country. I think if you look at aggregate measures of inequality at the very high level, and I think Ben Broadbeck may have made this in the letter he wrote recently, we haven't seen actually very large changes really since the 1980s actually. What I think we have seen is intergenerational changes.
Yes.
I think there's some very interesting work the IFS have done in the past, which sort of cuts the population up into which decade you were born in. And I remember now, I think it says that it's those born in the 1980s were the first decile, if you like, or decade, to be less well off than their predecessors, measured on sort of, certainly on asset ownership, I think possibly income as well actually, but certainly on asset measures. And that, of course, is quite a big change because that previous trend had really been going since the Second World War, actually. So, yes, I think we have seen changes in that respect.
Yeah, there was a really good article on the BBC News which was called 7 Reasons It Helps to Have Rich Parents. And one of them was looking at this intergenerational impact as well. But I think I've run out of time, so thank you, everybody, and thank you, Chair.
Thanks, Emma. Siobhan, please.
Oh, thank you. My questions look at the impact at the end of the furlough scheme on employment, reports of shortages and friction in the labour market, and the impact that these will have on wage and growth. First to you, Andrew. In a recent speech, you talked about the labour market puzzle and the uncertainty over how it will be resolved. What are some of the ways you think the resolution can happen, and how difficult will it be?
Yeah, so as I said earlier, I mean, quite honestly, I mean, we did not have in our previous forecast that there would be 1 million jobs on the furlough scheme till the end of the scheme. In large part because the government reduced the sort of attractiveness of the scheme as it approached its sort of tail end, and we thought that would sort of cause a sort of reduction in numbers, but it didn't. Anyway, well, it did somewhat, but anyway, there was still far more on it until the end. So the question is what happens next, and obviously this is what we're waiting for in the data. But I think broadly, what could happen? Well, one, obviously those who were on furlough return to their previous jobs. Now, I think quite a bit of that has happened. I mean, I do talk to companies a lot, go around the country talking to companies a lot, and a number have said to me, yes, we took our employees back at the end of the furlough scheme because we're experiencing a pickup in activity or we expect it. So a good case in point would be some of the airlines who said, yeah, we are expecting activity to pick up. In fact, it is picking up now. And therefore, we're taking our staff back because we don't want to lose them and have to recruit new ones. So I think that will have gone on. I think, I should say the furlough scheme also, I mean, I think just over half the jobs on furlough at the end of the scheme were what was called sort of full furlough, and the other half were partial furlough, so part-time jobs. So those on part-time, of course, could have gone into other jobs. And by the way, it wasn't an abuse of the furlough scheme to have a job in another sector. So you could, of course, have had people who'd already got other jobs or got what they wanted elsewhere. And so the furlough scheme came to an end, but they didn't go into unemployment. So obviously, people could have, some people will have gone into unemployment. And we've seen a bit of survey evidence now around that, I think, which is quite a low number. I think it's actually probably a bit lower than forecast would imply, I think.
Yeah. I mean, there have been two surveys, if I may.
Yeah,
So one is by the ONS in the Business Insights survey, and that's a survey of firms. And in that survey, they found that of people who had been on furlough in September, 3% had been made redundant since then. And there was a survey which was released over the weekend by the Resolution Foundation. So that was a survey of people. And that found that of those who had been furloughed in September, 3% were unemployed since then. So for both of those surveys, there are some people who may have gone into the jobless figures, but it appears that the vast bulk of those on furlough have gone back to work.
We haven't seen a marked pickup in redundancies. We haven't seen much pickup in redundancies at all, actually. Now, they don't cover small firms, that's the other thing I would say, and we do understand that there was quite a heavy usage of the furlough scheme by small firms.
And but these
So,
surveys...
a point there that I think is important to remember is this, that forbearance, particularly by small firms, ends March or April next year. And so even the agents have raised the concern that there could be a shoe to drop with regard to employment situation when that forbearance ends. So that's another factor in the labor market dynamics that is certainly something to keep in mind.
Well, I just wanted to say that the surveys that Michael mentioned, and notwithstanding what Catherine just said, which I recognise too, they suggest a little bit higher level of redundancy at the small 0 to 9 sort of size businesses, but nothing dramatic. So at least thus far, not really pointing in the direction that Catherine has said. And just to kind of link that to our forecast published last week. So we were forecasting anyway a relatively modest rise, only a 0.1 of a percentage point rise in unemployment in this fourth quarter on the back of the end of the furlough scheme. And the type of information that we've discussed would actually suggest unemployment may come in lower than that.
And if we're just talking about furlough, the last week the Times reported that hundreds of companies set up after the government's furlough scheme was established claimed up to 26.6 million from the taxpayer. Yeah. I wonder if you've made an assessment of the level of fraud associated with furlough or other coronavirus financial support
We haven't,
schemes.
I'm afraid. That would be a question for the Treasury, really, not for us.
Okay. The Monetary Policy Report notes that there is a high degree of uncertainty about the near-term outlook for the labour market, especially given the government's furlough scheme closed at the end of September. Does that suggest that unemployment rate forecast of 4.5% in Q4 2021 is unreliable?
Well, I think you may want to
I think I may have inadvertently answered that question already, but so sorry for that. But
don't worry.
I mean, I think there is a remaining uncertainty, and as Andrew said in response to an earlier set of questions, we will see more data tomorrow, which largely covers the third quarter, but some payroll data for October, so after the end of the furlough. And then we will see more labour market data before our next meeting. So there's still quite a lot of shoes to drop in that respect. And, you know, I don't know what that data is, so that is a residual uncertainty. But on the basis of the information we have now, to the extent that some of that uncertainty has resolved itself, it's actually resolved itself in a positive direction, meaning unemployment turning out probably slightly lower than we would have anticipated when we made the forecasts. I think the sort of fly in that more optimistic view, at least viewed through the lens of unemployment, is precisely the one that Catherine mentioned, whether the end of various schemes which are sort of delaying winding up orders and other insolvencies, if that shoe is to drop at some point over the next few months, we may see unemployment rise as a consequence of micro businesses going through that process. So that remains a kind of risk in the opposite direction. But the information we have thus far is actually on the other side.
Nobody else got any? No. Okay. UK job vacancies are at a 20-year high, including over 105,000 vacancies in adult social care. However, there are recruitment difficulties despite unemployment being above its pre-pandemic level. Why do you think that is?
Well, I gave some of the numbers earlier. I mean, so we have seen the public sector expand, and that obviously is that's in a sense in competition for in the recruitment market. So through the COVID period, we've seen an expansion of the public sector. We think the population, therefore the labour force, is smaller than it was expected to be on the pre-COVID trend. So that would obviously, again, tighten the labour market and make it harder to recruit. And as I said earlier, we've got this question mark about people who've gone into inactivity as to whether they're going to come out of inactivity and re-enter the labour market. But again, all of those things would contribute to the story that you are, you're giving.
Thank you, Chair.
Thanks, Siobhan. Gareth.
Chairman, thank you very much. Governor, I want to ask about the economic outlook, starting with business investment, if I may. We're still seeing quite low levels of business investment in the country, and we had the OBR here a couple of weeks ago, and they were pretty pessimistic about the long-term prospects for business investment. So how concerned are you about the current levels of business investment, and what do you think needs to happen for it to recover?
So, I mean, I'll start, but I'm sure others will come in. We've had very weak investment during the COVID period, indeed in recent years. I think one important explanatory factor for that is very high levels of uncertainty. There's a reasonably well-established relationship that high levels of uncertainty tend to cause businesses to put off the decision to invest. We actually have very strong investment in the forecast for the first half of the forecast, in other words, next year and a bit beyond, but not into the second half. And that's, I would say, two factors behind that. One is we hope the uncertainty is going to be lifting, particularly COVID-related uncertainty. I mean, I should just say as a general observation there that it's interesting that COVID actually has not been a large factor in the forecast that we have just done for the first time. The second thing is the fiscal policy measure, the capital allowance super deduction. And so we expect a quite strong boost to investment in the short term. After that, I think it's driven far more by the sort of the longer term determinants of potential output. And we've done again and published in a report as one of our periodic stock takes of that. It does return to some of the slower underlying levels at that point. I don't know if you want to come in on that here.
I can come in and talk a little bit about investment.
Yeah.
So I do try to take a perspective from the business side of things, because in my view, business investment is a driver of potential output, the long-term potential of the economy to grow, but also is also a demand. I mean, you need to buy things and machinery, equipment, IT, and so forth. So it really is a factor that is relevant for both the supply side and the demand side of the economy. So if we want to think about positives, positive drivers, certainly in the near term, the super deduction is one of those. But also the information technology products have been an important driver of investment in the COVID period as workers and firms try to figure out how to set themselves up for a hybrid workplace. And so that has been a strong element. I think there's also post-COVID, or as we exit from COVID, in the environment of a very strong labor market, firms search for ways of doing their businesses more effectively with the workers that they do have, and recognizing that it's being very challenging to hire new ones. So there's capital labor substitution as well as complementarity. So those are important drivers of investment, and so that's a tailwind for investment. On the other hand, the headwinds I think are very important. The uncertainty one we've already talked about, but there's also a headwind in what we think about is what's the long-term demand for products, and that's both the domestic side and as well as a global side. And as our forecast is for moderation in both domestic demand as well as in some global demand. And we have to recognize there's some headwinds coming from the trade barriers and trade administrative barriers that also represent a headwind for broad-based business investment. And because the global market is a very important component of a business's strategy. And a third headwind has to do with the gap that we still see, the gap between the trend for GDP prior to COVID and where we are now. We're back approximately to the growth rate prior to COVID, but we are still 2% or so below where the trend was going, what we thought GDP was going to be prior to COVID. And so if you were a company 5 years ago or 4 years ago, and you were estimating what investment you needed in order to satisfy demand, you would be looking at a situation right now where you say, I don't really need to do any investment because the demand is not going to be there relative to what I thought it was going to be back in, say, 4 years ago. Now, all that sort of is a negative in terms of business investment prospects, but there is a very strong potential driver of business investment that comes out of the transition, energy transition. If we think about a commitment to energy transition, and of course, getting there is to that commitment. It's not just about monetary policy, it's a much broader government policy commitment. If there's a commitment to a change in the relative price of carbon, then we are talking about companies having to change their product process, their products themselves, and probably workplace practices along with it. Those are the three elements that drive innovation and capital investment: change in product, change in process, and change in workplace practice. So there is a pot of gold at the end of the energy transition rainbow, or getting there, that has to do with really driving a major change in business innovation and business investment. It's not something that monetary policy has the major role to play. There definitely, we do play some roles. It is much more fundamentally, but it is a very key game changer for a driver for business investment.
Okay, thank you very much. That's actually a really good comprehensive overview of the long-term prospects for and risks to business investment. But let me ask you, Hugh, about the short term, because Catherine did mention the super deduction. Some have said that this is going to be more of a shot in the arm to move investment by time, not necessarily by volume. What's your view?
I think, in part it's intended to do that, and I think it will do that. Part of the reason, as Andrew has said, we have a more optimistic view of investment in the near years of the forecast is precisely for this sort of substitution effect. Now, does that make it a problem? Of course, there are issues about you might want to smooth this through time, but in terms of creating some momentum in a component of demand which has been lagging for the reasons that have been discussed, we certainly see that there's evidence that we're headed in that direction. Just to build on a couple of things that Catherine said, if you look at the information provided by the agents to us, which again is reported at some length in the monetary policy report, there's a box describing this. They have asked their contacts about what the outlook for investment is. After a number of very barren years, we're now seeing quite a lot of positive views looking into next year, in part as uncertainty and so forth recedes, but also reflecting some of the aspects that Catherine described, including the climate transition story. So the super deduction is part of that, but I think if you look at least what agents report from their contacts, it's not the only part of why we see investment picking up in the course of next year.
Okay, thank you. I just want to move to consumers now then. The OBR have said in their session with us that our recovery will be a consumption-led recovery. And in your report, you outlined that a lot of the consumption that we're seeing, we saw in the last quarter, it was up in some areas, down in some areas. But in your report, you said that a part of it is driven by household savings. And I know you've mentioned this before, Governor, in this session. But can you just explain a bit more about your assessment of household savings and how that is having an impact on your economic outlook?
Yes, so as I was saying earlier, we've seen quite a substantial build-up in household savings during the COVID period, and that's household savings in excess of what they would otherwise have been. And as we discussed in a number of past hearings, we've obviously had a question then, which is, well, what do we think is likely to be people's attitude and sort of behaviour in terms of those savings? It's pretty hard to assess because there isn't a lot of precedent for this, actually. I mean, unfortunately, we don't have pandemics too often in history. What we know is that, going to the point I was making about the concentration of the savings, is that they're concentrated amongst people who in normal times have a fairly low propensity to consume out of wealth. But these are not normal times, clearly, so that's only good as far as it goes, and it doesn't go very far. I mean, from the evidence we've been able to sort of muster, which is partly obviously using surveys, asking people, partly using some other countries where they're a bit ahead of us in terms of coming out of COVID. So New Zealand would be another example, another point there. Yeah, the evidence is it's not a very aggressive run-off in savings. So we've made this assumption that only sort of 10% of those savings are spent in the sort of over the forecast period. And I should say that so far we haven't really seen any evidence to call that into question at the moment, so we've stuck with that assumption.
I think I'm at time, so I'm going to race ahead and just ask you one last question and pick up on something that you just mentioned to my colleague. Is it safe to say now, or are you saying that we have now turned a corner and that COVID is no longer a predominant factor in driving our economic outlook?
Well, I'm not going to make take any view on the health side of it. Although I've said before, we do actually talk to Chris Whitty as part of our forecast round, and he's very helpful. But
COVID is no longer the predominant.
Well, what I was going to say is the economic impacts of COVID have attenuated substantially over time. Mm-hmm. So we go back to last spring; it was having obviously a massive effect on economic activity. It has attenuated over time. So in that sense, yes, and obviously the vaccinations have been a huge help in this respect in terms of supporting economic activity.
We have turned a corner, and that
let's hope
it is
so.
No longer the predominant.
I hope so.
Right, thanks, Gareth. Rishanara.
Good afternoon, and yes, we live in hope. So my question is going to the international sort of dimension and the UK's position linked to that. So what we've seen is, and in your own report, you talk about GDP growth is expected to be relatively subdued. And when we look at comparisons to other G7 countries, Germany, Italy, France, USA, the UK economy is behind in terms of returning to pre-pandemic levels. What would you say? I mean, obviously, we've talked about investment. We've talked a bit about some of the challenges around labour shortage and so on, and the global dimension. What are the other factors to the UK's recovery that are likely to impede recovery and catch up with other G7 countries? And to what extent does fiscal policy impact on that recovery?
Well, I mean, they're all in a somewhat different place. I mean, I think comparison with the US is helpful. I might bring Catherine in at this point. I mean, the US has used fiscal policy extensively, and I think certainly that has had an effect in terms of the timing of the recovery and timing of the getting back to sort of where we were pre-COVID. I would say I think that is a factor to be borne in mind. Catherine, do you want to come in on that point?
So it's the magnitude of fiscal policy as well as the tools used. If we compare, for example, just the U.S. and the euro area, just because you can sort of between the two of them, the U.S. very large fiscal effort, very much focused on consumers, giving them additional spending power. We see that dramatically across the global economy in the context of the goods prices that we've already talked about before. The euro area, and then the U.S. Achieved the pre-COVID level of GDP quite some time ago. Although note that in the U.S. the labor market has not yet returned to the pre-COVID level. So that's an important distinction. Now, euro area deployed a smaller fiscal package, but more importantly, the fiscal packages were very much associated with help to businesses and to maintaining employment relationships, but help to businesses, particularly through guarantees. So there, in some sense, there wasn't as much of an addition to the pocketbook that would then show up in spending. And the euro area is not expected to return to the pre-COVID level of GDP until sometime next year.
Thank you, Catherine Mann. But can neither of you or any of you explain why there's a difference between the UK and other some of the other EU countries that I'm referring to, like Germany and Italy and France?
If I may, one issue, and this is to get quite technical, is over the deflators for government output. Yep. So if you look at nominal GDP, in other words, not converted into real terms, there's actually not much difference between the UK and the major European countries in terms of the recovery compared to Q4 of 2019. Mm-hmm. But in the UK, the GDP deflator, the price of GDP, if you like, has risen more strongly than in those other countries, and public services have shown weaker volume growth. And quite a lot of that is just due to differences in the way in which public sector output is measured across countries. And so when you're considering the comparisons across UK versus EU, you have to allow a little bit for that.
Okay, and in terms of the response and going forward, you'll probably say it's not for you to answer, but I'm going to try this anyway. Are we, in terms of some of the changes that are coming in next year, for instance, in terms of national insurance contributions and so on, how much will the pressure on household income, alongside some of the other pressures around cost of living costs like fuel price and food price, how much do you anticipate that having a knock-on effect on the wider economy and our ability to recover quickly? Or is it kind of very minimal?
Sorry, is that for me?
Whoever would...
So look, the national insurance increases, as far as I understand it, are matched by increases in public spending. Yep. So the overall effect on GDP of that is really very small. Yep. It shifts around the composition of GDP.
Yes.
But it's not really going to affect the aggregate, and it's really the aggregate which we're most focused on.
Thank you. Hugh Pill.
A last point that I might want to make is that there is really a difference. You were making the distinction between Germany and the UK. I think there is an important difference having to do with the external current account balance, the trade balance, and there is a big difference there in terms of the strength of export demand between the two countries.
Okay, great. I'm going to come on to that, but I'm going to move to Hugh Pill. So the data released last week shows that the US has seen a 6.2% increase in the cost of living over the past year, and price pressures have broadened, and senior federal Fed officials have now, some are arguing that it's no longer transitory, and we've heard the word transitory being used quite a fair bit today. What's your view about whether the UK inflation is transitory, or is there a debate going on about that similarly to the US?
Well, I think, the core reasons why we've seen a rise in inflation since the May monetary policy report. First, there are some base effects. So dropping out of the annual calculation is the very low rates of price increase we saw in the immediate aftermath of the onset of the pandemic. That's actually telling us more about what happened in 2020 than what's happening now. But I think it's important to see that there are basically two reasons why inflation has surprised the upside. So one is closely related to what Catherine was just saying, namely goods prices have risen very significantly. We see that, given that goods are generally internationally traded, as a reasonably global phenomenon. And why have they risen? Well, I think it's a combination of the fact that there's been a continuation of the rotation of demand into buying goods at the expense of services. This is kind of, to give it a punchline, people bought flat screen TVs rather than going to the cinema because of the COVID situation. Together with the disruptions to global supply chains associated with, for example, in China, still a zero COVID type of policy, which is shutting down production in China, which is quite crucial to a whole set of global supply chains. So that's boosted global prices of goods, and we are an importer of goods, so we are subject to inflationary drivers from that source. And, just to repeat something that came up earlier, but very briefly, the impact of higher global energy prices, which we are particularly associated with.
My question is, apologies, but my question is, in summary, would you stick to the line that the inflation that the UK is facing is transitory rather than something more longer term?
Right. Well, I think, the point I guess I would make to that is those drivers are transitory because we don't expect energy prices to continue at recent rates. And we do think, although maybe more slowly than we would hope, some of these disruptions to global supply of goods and a renormalization, it goes a little bit back to the question, as the COVID, perhaps we still do start going to the cinema and we buy fewer flat screen TVs, if you like. So that renormalization of patterns of demand will ease that. Now, of course, the key question, which is where we started this afternoon, is will you create some so-called second round effects? So some impact on wage and price setting paper coming from the higher inflation we've seen. And our view remains, as we discussed earlier, that we have, through acting in an appropriate way, a timely way and so forth, we will contain those second round effects and prevent this persistence.
Okay, I'm going to come back to other panellists just in terms of the impact of the inflation in the US and given the bigger stimulus package. Do you see any spillover effect in terms of the impact on the UK economy in terms of the sort of knock-on effect beyond the transitory points that you're talking about? Perhaps Catherine or Hugh, if you
Well, I mean, I would just make the point, then I'll obviously hand over to others, is that there's no doubt that some of the momentum between the international demand for goods, which is part of this story I just told, has come from the fact that the US fiscal policy support, particularly to consumers, the stimulus checks of last year, a lot of that has been spent, and it has been spent on internationally traded goods. So that impetus to global demand is something that we are experiencing through the impact on global goods prices.
It's affecting shipping prices, for instance, because it's an internationally competitive industry. I mean, as Hugh says, I mean, US consumer durables demand has been very strong. That feeds through into trade, feeds through into Chinese output, for instance. Catherine, you may want to come in.
Well, I don't think I have anything to add on the trade side of things, but there is another channel through which sort of very robust U.S. growth and high inflation may affect the UK economy, and that is the channel of international capital flows and cross-border interest rate adjustments. And in the past, it's been there's a global factor in policy rates. And that has been, the global factor in policy rates tends to be driven by the Federal Reserve. Federal Reserve tightens, that has spillover effects to global economies, global capital flows, and therefore impacting the UK economy as well. As in the past, that channel has sort of gone in the direction of the Fed first, and then spillovers to other economies, including the UK. I think we have to. We're not going to comment on what the Federal Reserve might or might not do at their meetings, but it's certainly a factor that is relevant to consider as part of our own sort of thought process with regard to the conduct of policy.
Great, thank you. I've got two more questions for the Governor. One in relation to the UK-EU disputes over the implementation of the Northern Protocol. Does that pose any risks to the economic outlook?
It's not a risk that we've factored in. We follow it from in terms of trying to work out what's going on, but it's not a risk that we have factored in explicitly. No.
Do you think you should?
Well, we'll keep a close watch on it. Clearly, I'm hoping, as are we all, I'm sure, that this will be resolved one way or another. But we're certainly watching it very closely.
Right. Okay. And the OBR forecast of the 4% hit on as a result of a longer-term hit because of Brexit on productivity and GDP, and then the 2% COVID impact. And obviously you've been looking at this over a number of years. What does this all amount to for the UK compared to other EU countries that are not in that position where they're primarily dealing with COVID impacts and global supply chain issues, and likewise with the US? Where does that put us compared to other countries in terms of how we recover and our economic outlook versus other countries, and what should we be doing? to make up for that? Obviously, been talking a lot about productivity and investment. What would you say?
Just on those two elements of the numbers, and I'll come back to the point you've just been making. We haven't revisited the Brexit effect. I mean, as you know, we've talked in the past about the longer term Brexit effects that we have in our own view. I mean, we will.
When will you be?
Well, I don't know yet, because for the reason I said earlier, that at the moment it's very hard to separate Brexit and COVID. And
the OBR seems to have been able to do it. So,
in
terms of
they're also, if my memory is right, going to do a much larger piece of work at some point in the future. I don't think they've done us.
These are really big issues.
But we just can't separate. The data just don't allow us to separate those two effects at the moment. I mean, they're happening they're having similar effects.
Okay, well, let's focus on what we do.
On the scarring point
about those
raised,
effects.
On the scarring point you raised, I mean, the OBR, interestingly, I think now their latest forecast comes sort of towards our number, actually. So their number, they had a higher scarring number. We were lower down. I think the numbers are sort of converging more now. It's getting increasingly difficult, though, to isolate the particular COVID effect on scarring, because as time goes by, other things start to come about, obviously including these supply disruptions. But at the moment, I would say the 2% that you were quoting, those numbers are a lot closer than we probably were earlier this year, actually. Now, just coming back to a final point, I think it goes back to something very important that Catherine said earlier, which is, if you think about what are the opportunities ahead, I mean, Catherine set out a very clear, I thought, and something I agree with very, very much, which is the sort of change that is going to be required if we're going to get to the COP objectives is going to require a very substantial amount of investment. So it is both, you can see it as a challenge, but you can also see it as a very big opportunity, as Catherine was rightly saying.
So, sorry, Governor, to push you, but how do we fare with other countries that haven't had to go through haven't got this 4% or 3.25% if we take the Bank of England figure, but the most recent figure is from the OBR, which is 4%. How does Britain fare, given we've got this extra challenge?
Yeah, well, certainly.
How do we recover from that?
Well, certainly what you can see at the moment is that I think if you look at trade numbers at the moment, there is a somewhat bigger impact on UK trade at the moment over the last 2 years than in other countries. The biggest part of that, I should say, is imports from the EU. It's not so much exports to the EU, it's imports from the EU, which are the weakest of all. There has also been some effect on services trade, which we expected. I mean, we did expect. I mean, put the financial services hat on for a moment. It's not unsurprising that there has been some effect. Now, I think if I comment on that part of trade for a moment, I think there's still a lot to play for on that front, an awful lot to play for. And, I think, there are some things that are working out, I would say, in a sensible way, which suggests that actually, we can cooperate productively in the future. So I would single out the announcement the EU made on clearing last week. Not because it's not a triumph, I'm not saying anything triumphalist at this point, I don't believe that for a moment. I think it is just, it is a sensible announcement. Of course we would say this, wouldn't we? We think, we can work together cooperatively in everybody's interests. But it is, I hope, a sign that actually a sort of constructive working together can emerge, certainly in that part of the economy.
Yeah, I've just got one final one for you, which is about vaccinations. So we talked about China and the zero COVID point, but across Asia, the vaccination rates in Africa as well are much lower. And certainly that's having a knock-on effect and disruptions. So what steps need to be taken? Where do we need to get to reduce those sets of barriers caused by closures because of COVID and lockdowns and so on in specific parts of the world economy? And shouldn't we be doing it? I mean, obviously we've been talking about this since the pandemic began, and concerns about global supply chains, which is kind of, frankly, coming home to roost now. It's not like people weren't aware of this, this time last year even.
The factor in it. I mean, there's two arguments. There's two sort of things running together here, which we've both discussed. One is this, still concentration of demand for goods, which is increasing global trade pressures, increasing shipping pressures, increasing shipping costs. The other, as you rightly say, which then compounds it, is this question about vaccination and responses to outbreaks of COVID. And obviously when, for instance, Chinese ports get closed down, that has a direct effect. I mean, I'm not, I'm afraid, qualified to comment on Chinese vaccination policy. I
Not
really am not.
Chinese vaccination is less of an issue, but there are issues about supply to other parts of the
Yes.
world, which is having an effect,
Yeah.
which we've talked about for some months.
Well, I think, look,
The international community has not really addressed that fast enough. It's having a knock-on effect on supply chains.
all I would say is it is, in my view, a global public good that
Yeah.
vaccination is widely done.
Thank you.
I think it's for others to determine how that's done. It is a global public good.
I don't know if anyone else wants to come in, otherwise I'm done.
Okay.
Thank you.
Commissioner, thank you. And finally, Alison, please.
Thank you very much, Chair. I've got some questions around monetary policy's role in net zero targets. I'm obviously, having had COP in my constituency, I'm quite keen that the agenda set continues from there. And in the latest remit letter from the Chancellor, the MPC's secondary economic policy objective includes support for transition to environmentally sustainable and resilient net zero economy. Is that something that monetary policy can do, in your view, and how?
Well, monetary policy can make a contribution. I mean, the Bank of England's got quite a few sort of irons in the fire, as it were, and interests in this, and they go beyond monetary policy. But let me just talk about monetary policy. Well, the broader part of monetary policy. So, two parts to that. One, we announced just over a week ago our policy towards the corporate bond portfolio that we hold. We've been doing a review during the course of this year. And how we want to, in a sense, use that policy towards that portfolio to incentivise change. And it is very much a policy of incentives. I mean, we're going to come up with, building on the work that's being done more broadly, because we're involved in it, particularly encouraged by the announcement on international disclosure standards that was made at Glasgow. And building on that, we want to be able then to sort of, the future choices we make on investments in that portfolio will be incentivised towards firms that are meeting climate targets. And we will, as we put it, tilt our investment decisions in that direction. We will also not be making coal investments. That will not feature in the investments going forwards. All of those are sort of consistent. They're not diverging from the monetary policy purpose of this portfolio, but we think they're consistent with managing it in a way which is consistent with setting incentives. And I should just add on that we do get such, told from time to time, well, why don't you just sell the bad investments, as it were? And my answer to that is, well, I don't think that would help, because I'm afraid they would end up in the hands of people who would want to exploit, to sweat the assets, as it were. I think it's much better. It's not a very big portfolio. It's about 6% of the UK sterling corporate, or the sterling corporate bond market. But I hope that we can use it to create incentives that others will then follow. The second thing, and it sort of goes to what Catherine was saying earlier, is that a lot more needs to be done on what I call the macroeconomic scenarios of climate change. Now, we've done a huge amount of work in that field. I'd like to say we're somewhat world leaders in that field, working with other central banks. But there's a lot more to do on that front. I mean, climate is now, I think, coming sort of right into the monetary policy horizon. I mean, I think, in times gone by, I think, some monetary policy makers say, no, it's over our horizon. We're not in that business. And indeed, we were doing far more of it in the financial stability supervision world, which has a longer horizon. But you can't say that anymore. I mean, I think some of what a bit of what we're seeing in energy prices at the moment has a link to climate, to climate considerations. And so we need to do more, I think, in terms of those scenarios. Monetary Policy Committee had its first sort of discussion of that a couple of months ago, 2 or 3 months ago. It will feature much more on our agenda going forwards.
Okay, thank you. That's very interesting. I'm glad to see that you included coal. Will you be looking at other fossil fuels within that as well?
Well, the tilting, yes. Well, the tilting process in terms of tilting to get the sort of those whose bonds we own to meet both the intermediate test 2025 and the net zero test. So yes, we will come through in that way.
Okay. I was going to ask how you talked about some of the sort of disclosure standards and the data and aspects like that. How can you be sure that you're getting the right data to make the right decisions when that comes in front of you as a committee?
that will be important. It'll be important internationally. I mean, we're just setting off down this road, and I think now that there's been agreement to set up the new financial reporting standard and the governance and the board behind it, and I'm very pleased that we've got agreement on that. I mean, a huge amount of work's gone into that. But I can also say, wearing a different hat of mine, that the Global Financial Stability Board will have a role in overseeing the implementation of that. And for my sins, I've just been appointed chair of the committee that I think is that job. So there is a lot of, and it's got to be done globally, because we can't do this, do our own thing on this front.
Okay, thank you. I wondered if perhaps some of your colleagues would like to come in, because Dr. Mann was talking earlier about the impact of innovation on net zero, and what more within your own role in the committee do you see as part of this?
So I think there are two comments. One is the extent to which the central banks and regulators have been working together for some time, so that there's a base of cooperation already there, so that now that we have the standards, the disclosure standards, that can be applied more globally through the regulated entities that they have in place. So the point that I think is important to kind of keep in mind when it comes to thinking about especially the disclosure standards and the role of the central banks and regulatory community, is that ultimately what we want to be doing is setting up a strategy that will incentivize the private sector, because there's no amount of government money that's going to get us to the transition, right? So it has to be incentivizing the private sector, and the best way to do that in a coordinated way is through these bodies that have been created and have been working together for some time to have the standards that are global and that create a level playing field, so that we move the investment community forward, the financial investment community as well as the private and business investment community. They have to be working together towards this goal.
And if I could add, one of the other things which the bank is doing is through the decision makers panel, it's a very wide survey that we do, is trying to understand better the extent to which climate change objectives are currently driving firms' investment choices. And you'll see we published the latest DMP survey a couple of weeks ago, I think.
So there's
thank you. And so there's a chart or two which shows how these issues are affecting firms' investment choices now. And by finding that out from companies, by sort of shedding light on it, you're better able to pick up on firms which are slower. You can engage in conversations with them to say, well, look, these are what your competitors are doing. What about you? That just helps to create an environment in which it becomes an integral part of firms' planning.
That's interesting. And to what extent do you think that is part of the planning at the moment then, from what you've found so far?
Well, the DMP survey suggests that it's a fairly widespread and on balance positive effect on firms' investment choices. And I have to say, talking to firms over the last few years, there's been a massive change in their attitudes to this. That it's gone from being something which was a relatively peripheral issue to now across most firms, most sectors, they're grappling with it.
And is that
one of the I was going to say one of the other panelists was concerned about the UK relative to other economies, and on this, I think that the European Investment Bank also has a survey of firms asking similar questions as the decision-making panel, and so we now have information about how firms are reacting to prospects for climate transition at the European economies. The US economy is also included in the EBIS survey, as well as the UK. So there's quite a bit of information to bear on this.
Okay, I'm certainly going to look at that in some more detail. I wondered if there's any evidence that people are doing what the governor perhaps suggested people shouldn't do, and just withdraw all their money from coal-based industries, or are they investing in transition away to move things into newer terms of newer types of technology?
So I'd say, so my impression, I don't know, is whether others have a different view, is that firms are investing to transition.
Okay, that's interesting. I was going to ask just briefly about the greening framework. So the greening framework is subject to maintaining the CBPS's primary monetary policy purpose. Are you satisfied that it will do so?
Well, we're not changing to say that the size of it. In that sense, it's the makeup of it that will affect it. So I think from a monetary policy point of view, it won't happen. And by the way, I mean, all of this is conditioned on the fact that, you know, the Monetary Policy Committee will at any point in time be able to take a decision on the future of the portfolio. We haven't taken a decision. We've taken a decision on what we're going to do about the gilt portfolio, which is much bigger. This is quite small, very small by comparison. We haven't taken a decision on the corporate bond portfolio. We've been very clear from a monetary policy perspective that any policy we have on the greening side does not override the Monetary Policy Committee's ability at any point in time to take a decision on what it wants to do about the portfolio in terms of whether we have it or not.
Okay. And has the bank made an estimate of the impact of the greening framework on the borrowing costs of firms at all?
No, that's an interesting one. Wouldn't really fit into the Monetary Policy Committee's sort of remit necessarily. I'd be happy to write back on that, because it's an interesting question, actually. I could get our climate people to sort of have a think about that.
Okay.
Yeah.
So I've not brought you in here.
No,
Have you anything you want to add on the impact of COP and the work of the MPC?
I don't have anything. I mean, the only thing I would say, just to add to Andrew, is I think we'll be looking to see, we only just started on the greening, so I think it's a natural question to try and assess what impact it has on pricing. A difficult question, but a natural question.
That's good. Thank you very much.
There is information in the markets more generally about the relative borrowing costs of for green bonds versus regular bonds that have been. It created an attractive environment for those borrowing more generally because of the demand on the part of the investment community for ESG type of bonds. So it has been beneficial to those companies issuing green-oriented bonds.
Okay. Thank you very much.
Right. Thanks, Alison. And that brings us to the end. So thank you very much to our witnesses for appearing before us today. And in particular to Hugh and Catherine for your first appearance before us. We look forward to seeing you again on many other occasions. It strikes me that the big word that hangs over all the grapplings there have been for answers today is uncertainty. There's so much uncertainty in the economy. But the good news is that there will be answers to all these essay questions in time. And we will have you back at future sessions and we'll be able to discuss them with you then. But thank you very much indeed for attending today. That concludes this session.
Thank you very much.
Order.
Thank you.
Order. Thank you.
Yes, we did.
Green bonds.
I'm really sorry just walk my way through it.
I'm sorry that when you asked me, I can see Catherine.
Thanks very much. Thanks.